Welcome to your daily business news update. Fast, clear, and straight to the point. Europe's tech rules could reshape how Google makes money from search. According to Reuters, Google is preparing to test changes to how it displays rival travel and vertical search services in European results. The rollout could begin with hotel listings, then expand to flights and restaurants. The move is a response to enforcement under the EU's Digital Markets Act, overseen by the European Commission. The law allows fines of up to 10% of global annual revenue for non-compliance. No revenue figures or permanent layout changes have been announced. These are tests. Alphabet shares traded within a narrow range around the report, reflecting regulatory risk rather than confirmed financial impact. For Americans, the issue is indirect but significant. Alphabet is a major weight in U.S. index funds and retirement portfolios. Any shift in European ad revenue could affect overall earnings. Next, investors will watch for data on traffic, ad pricing, and feedback from EU regulators to determine whether these tests become lasting changes. Moving to our next story. Reporting from The Guardian and Reuters highlights testimony in a New Mexico trial involving Meta Platforms. Investigators said Meta's AI systems generated very large volumes of automated child safety reports, many described as low quality or lacking actionable detail. The case was brought by the New Mexico Attorney General. Testimony referenced reports sent to the National Center for Missing and Exploited Children and law enforcement task forces. Court exhibits cited internal discussions about detection systems and encryption trade-offs. Meta shares rose modestly during the same trading window as markets reacted to mixed headlines. No financial impact was quantified in the filings. For Americans, the issue is primarily investor and policy risk. Meta is widely held in index funds and retirement accounts. Prolonged litigation or regulatory penalties could increase compliance costs over time. Next, investors will watch for court rulings, potential damages, and any signs of advertiser response as the trial continues. Moving to our next story. Microsoft is expanding its sovereign cloud capabilities, a move that matters now as governments and regulated industries demand tighter data control and offline AI operations. This week, Microsoft announced upgrades that allow customers to run Azure services, Microsoft 365 tools, and large AI models in fully disconnected or locally controlled environments. The new offerings include Azure Local, Microsoft 365 Local, and Foundry Local for running multimodal AI models on local hardware. Separately, Microsoft outlined connectivity pilots with Starlink, operated by SpaceX, along with partners like Mawingo Networks. One program targets roughly 450 community hubs in Kenya to extend cloud and AI access in low connectivity regions. No revenue or margin figures were disclosed. The announcements are strategic, not financial updates. For Americans, the impact is indirect but significant. Microsoft is expanding Azure's reach into defense, utilities, and other regulated sectors where data sovereignty is critical. The stock moved modestly higher over the 2 sessions following the news. Next, investors will look for signed contracts and recurring revenue disclosures to determine whether these pilots translate into measurable cloud growth. Moving to our next story. Apple is expanding U.S. manufacturing, and investors are paying attention because it signals supply chain shifts and AI infrastructure investment at home. On February 24th, Apple announced it will begin producing some Mac mini units later this year at a new factory on its Houston campus. Reports from Reuters, Bloomberg, and The Wall Street Journal say some assembly will take place at a North Houston facility operated by Foxconn. Apple also plans to expand advanced AI server manufacturing in Houston and open a 20,000-square-foot advanced manufacturing center for workforce training. CEO Tim Cook described the move as part of Apple's broader U.S. investment strategy. The company did not announce new products or volume targets. This is an operational shift, not a demand change. Still, markets reacted positively. Apple shares rose about 2% on the day of the announcement. For Americans, the impact is mostly structural. The move adds manufacturing activity in Texas and reduces overseas concentration risk. For investors, near-term earnings impact appears limited, but the strategy supports long-term supply resilience and AI capacity. Next, Wall Street will look for details on production scale, costs, and margin impact as the Houston ramp begins later this year. Moving to our next story. Home improvement spending is closely tied to the U.S. housing market, and new guidance from Lowe's companies signals demand may stay muted. Lowe's reported a stronger-than-expected quarter, with sales of $20.6 billion, comparable store growth of 1.3%, and adjusted earnings per share of $1.98. But alongside that beat, the company issued cautious fiscal 2026 guidance. Management predicted full-year comparable sales ranging from flat to up 2% and adjusted EPS between $12.25 and $12.75, below many analyst expectations. CEO Ellerson cited high mortgage rates and housing lock-in effects limiting renovation activity. Shares fell several percent intraday, as reported by Reuters and Bloomberg. For Americans, the signal is broader than one retailer. Slower remodeling demand reflects ongoing housing pressure and could affect suppliers and peers like the Home Depot. Next, investors will watch housing data and same-store sales trends to see whether this slowdown deepens or stabilizes.